Good afternoon, investors. You are now on KleverStock with me, Madhavi, and I'll be serving you the midday roundup with the latest market updates from this morning up until now. Opening today's market wrap with a look at the domestic front, Bursa Malaysia is holding onto its powerful upward momentum, extending its broad-based equities rally to hover at fresh 2-month highs. The benchmark FBM-KLCI ticked up 2.99 points to trade at 1,722.93 at 9:10 a.m., beautifully tracking an overnight rebound on Wall Street. Global risk sentiment received a massive shot in the arm after the latest batch of U.S. inflation metrics came in cooler than market consensus expected, temporarily easing international interest rate fears. Market analysts at APAC Securities note that they remain cautiously positive regarding the local benchmark's trajectory, even though U.S. President Donald Trump backed off from his controversial proposal to implement a 20% toll on commercial shipping vessels passing through the Strait of Hormuz. International Brent crude futures remain firmly elevated around $85 a barrel due to recent U.S. military strikes on Iran. Experts indicate that these elevated oil baselines will continue providing immediate operational support to energy-related counters on the local exchange, while Bursa Malaysia's inherent defensive corporate composition should insulate the market from broader regional volatility. From a technical perspective, charting desks point out that yesterday's aggressive surge past the 1,700 psychological resistance confirms that near-term trading sentiment has improved dramatically. A decisive close above the 1,720 level today will officially invalidate the previous bearish double top pattern that had been capping upside potential. If this bullish trend is sustained, chartists are telling traders to keep a close eye on the 1,760 to 1,770 zone as the next major overhead swing target, while the baseline support floor to monitor on the downside rests firmly at 1,674. Turning to active corporate counters, upstream plantation shares remain in heavy demand among institutional buyers, with IOI rising 9 cents to 4 ringgit and 60 cents. And SD Gateway picking up 10 cents to sit at 6 ringgit and 60 cents. Banking giant Maybank climbed 6 cents to 11 ringgit 6 cents, and Petronas Dagangan advanced 14 cents to reach at 19 ringgit 46 cents. While consumer titan Nestle jumped 24 cents to hit 90 ringgit 74 cents. On the volume side, penny stock favorite Tenco kept its crown as the most active counter on the floor, surging 7.5 cents to trade at 39 cents. Meanwhile, PA Resources added 2 cents to touch 20.5 cents, and Enest, which officially transferred its listing status to the ACE market from the LEAP market, dipped 1 cent to open at 12 cents. Moving on to local currency and foreign exchange, the Malaysian ringgit kicked off midweek trading on a stronger footing against the US dollar this Wednesday morning as international currency does aggressively position ahead of crucial domestic growth metrics. At the 8 a.m. opening bell, the local note appreciated to trade at 4.0740 to 4.0780 against the greenback, successfully clawing back ground from Tuesday's close of 4.0760 to 4.0800. Market participants are heavily focused on the Department of Statistics Malaysia's upcoming advanced second quarter gross domestic products estimate, which is scheduled for official release this Friday. In an early briefing, Bank Muamalat Malaysia Chief Economist Dr. Muhammad Afzal Islam Abdul Rashid stated that the domestic economy is highly likely to maintain solid upward momentum, projecting a firm GDP expansion of 5.1% for the quarter. He noted that this expansion is well supported by resilient global demand for localized electrical and electronic components alongside robust commodity exports. However, he cautioned that more conservative household consumption trends, which have tracked below historic averages for 3 consecutive quarters, will likely keep the broader GDP top-line figure in check. Simultaneously, a sudden macro shift in Washington is providing the ringgit with immediate room to strengthen. The U.S. Consumer Price Index for June registered its sharpest monthly contraction since May 2020, dropping by 0.4% month-on-month due to a massive tumble in global petrol and transport costs. These cooler disinflation data immediately pushed the 2-year and 10-year U.S. Treasury yields down by 8 and 4 basis points to hit 4.18% and 4.58% respectively. Dr. Aftaz Nizam indicated that if this soft greenback momentum persists, the ringgit could realistically attempt to breach the key psychological 4 ringgit and 5 cent level against the US dollar during today's active trading session. Over at the wider currency tables, the ringgit started the day on a highly mixed note against major international and regional peers. The local currency strengthened against the Japanese yen to open at 2.5117 to 2.5143, but softened against the British pound to trade at 5.5571 to 5.4625, and eased with the euro to sit at 4.6545 to 4.6591. Across regional ASEAN pairs, the ringgit managed a minor gain against the Indonesian rupiah to trade at 225.1 to 225.5, but experienced a fractional slide against the Singapore dollar to open at 3.1562 to 3.1595, while remaining completely flat at unchanged against the Philippine peso. Now for some economic news. Local credit rating agency MARC Ratings has officially affirmed its stable AAI as investment grade rating on Bharat Mobility Sdn Bhart's 1.5 billion ringgit sustainability Islamic medium-term notes program. Bharat Mobility is a dedicated special purpose vehicle established by its parent company SMH Rail Sdn Bhart specifically to execute strategic sale and leaseback transaction with the government statutory body, the Railway Assets Corporation or RAC. The multi-billion ringgit proceeds raised from the Sukuk issuance are being deployed to partially and partially finance the strategic acquisition, subsequent complex refurbishment or total mechanical replacement of 44 locomotives and 246 cargo wagons sourced directly from and intended for long-term operational use by the RAC. In a public statement, MARC Ratings highlighted that the highly secure rating is deeply supported by the strong multi-decade visibility of Bharat Mobility's cash flows, which are underpinned by robust 25-year lease agreements with a highly creditworthy government-linked counterparty. The credit profile is further fortified by tight structural debt protections, including the strict ring-fencing of all incoming lease payments into designated project accounts, as well as SMH Rail's extensive track record of more than 20 years of technical experience in specialized rolling stock maintenance, repair and overhaul services. However, the rating agencies tempered these credit strengths by noting standard operational risk such as potential contract terminations, engineering execution challenges, and minor delays in lease payment collections. MARC Ratings observed that the formal delivery schedule for the rolling stock has recently been revised due to external macro factors, including persistent global supply chain constraints. Crucially for debt holders, no financial penalties were imposed on Bharat Mobility following these schedule revisions. The rating agency added that while the altered timeline is expected to marginally reduce gross revenue, the top-line impact is fully offset by the significant interest savings and lower projected dividend distributions over the Sukuk tenure, leaving the company's core cash flow coverages metrics completely unaffected. Under MARC Ratings strictly sensitized and a stress test scenario, which model a minimum of 24 days of monthly lease payments, a lengthy 6-month collection lag, and 1-month project delay. Rapid Mobility's finance service coverage ratio is projected to hold comfortably above 1.50 times throughout the entire Sukuk lifespan. This baseline safety buffer is further reinforced by a binding corporate undertaking from the parent group, SMH Rail, to ensure the SPV maintains a minimum debt coverage ratio of 1.5 times across the entire tenure. And we'll now take a short break, but don't go away. We'll return shortly with corporate news and developments. Welcome back to the Midday Roundup. Let's continue with some corporate updates. Bursa Malaysia's most heavily traded active counter, Tanko Holdings Berhad, has officially hit another major infrastructure milestone for its highly anticipated mega project in Negeri Sembilan. In regulatory filing with the local bourse, the company announced that its indirect wholly owned subsidiary, Tanko Supplies Sdn Bhd, has officially entered into a memorandum of agreement with Halaman Mantap Sdn Bhd. The strategic deal secures the vital supply of up to 4 million tons of armor rocks required entirely for the massive marine reclamation works of its upcoming smart AI container port in Port Dickson. The extensive project reclamation is being spearheaded by Midsports Holdings Sdn Bhd, which is a 79% direct subsidiary of Tanko. According to the regulatory filing, both parties have set a 4-month timeline from the agreement date of July 14, 2026 to fully negotiate and lock down the precise specifications, exact quantities, pricing, and project timelines based on incoming engineering inputs. Once finalized, formal binding contracts will be executed, featuring a structured payment period for the massive armor rock supply that will stretch over a duration not exceeding 4 years. Operationally, Halaman Mantab will be strictly responsible for allocating and maintaining sufficient mineral reserves to seamlessly meet the structural demands of the port's construction. TANCO has explicitly stated that this early-stage memorandum is not expected to have any immediate material effects on the group's current share capital, substantial shareholder stakes, net assets per share, or gearing levels for the current financial year. However, market observers are looking closely at the massive long-term potential of the asset. According to the group's official project blueprints, the proposed smart AI container port will be built upon a strategic 480-acre TANCO-owned land bank. The location features a unique, highly coveted natural deep water access, boasting a depth of more than 21 meters at just 1.8 kilometers from the shoreline. This natural geographical advantage will comfortably allow the high-tech port facility to accommodate the world's largest global container mega ships, positioning TANCO as a disruptive upcoming player in the regional maritime logistics. Up next, we have a sector update. Kananga Research has officially issued a highly bullish turnaround forecast for the local plastic packaging sector this year. According to their latest strategy note, elevated international oil prices driven by persistent Middle East conflicts since February 2026 have triggered an absolute explosion in raw materials costs, forcing average resin prices to skyrocket by roughly 80% or more. Historically, massive resin spikes translate directly into highly lucrative operating profits for established packaging firms due to the industry's trading cost-plus business model. Looking at energy baselines, Kananga is forecasting global Brent crude oil to average $80 or roughly 325 ringgit per barrel throughout 2026 before settling at $74 in 2024. Maintaining the firm view that energy imports are highly unlikely to return to their pre-conflict baselines even if geopolitical tensions ease. Compounding these tailwinds, serious global supply shortages have suddenly emerged across the supply chain. These raw material crunch has not only driven a massive influx of aggressive panic buying and stocking orders from the existing clients, but top-tier local packaging manufacturers have also begun receiving urgent new order inquiries from entirely new international customers whose traditional suppliers have declared sudden force majeure events. Kananga highlights that because local manufacturers possess well-diversified raw materials and supply channels spanning the US, Asia, and the Middle East alongside incredible healthy cash balances, they face virtual zero supply disruptions that are primed to rapidly steal regional market share. Because there is a standard 1 to 2 months time lag between physical purchases orders and actual corporate revenue recognition, the bulk of these inventory gains and widening profit margins will be vividly reflected in the upcoming second quarter financial statements. The research house estimates that the most domestic players are holding between 2 and 3 months of low-cost inventories, meaning the sector will reap maximum profitability for a quarter or two by offloading cheap stock at current high average selling price. Consequently, Kananga is maintaining a high conviction over White State on the wider packaging sector. Their absolute top outperform picks remain Thongwan Industries with an unchanged target price of 1 ringgit and 73 cents alongside BP Plastic Holdings with a target of 87 cents per share. Analysts heavily favor Thongwan due to its robust growth momentum in the food and beverage packaging segment and its aggressive export footprint, noting the stock trades at a deep 20% discount to its historical valuation. Meanwhile, BP Plastics is highly favored of its elite quality stretch film centric business model and its success in locking down multi-year supply deals with reputable commercial bread brands across Malaysia. Conversely, the House downgraded copper heavyweights and the Syntax to the market performer rating following recent sharp upward share price appreciation. Finally, wrapping up, we have major corporate developments and the deals across Malaysia. Insights Analytics Berhad said its wholly owned subsidiary Insights Analytics Technology Sdn Berhad has secured a 4.3 million ringgit contract from Sarawak Information Systems Sdn Berhad to provide maintenance and support services for the IntelliWater system. CPE Technology Berhad has entered into a joint venture with Japan's Kanikita Co. Limited to manufacture high-value stainless steel semiconductor components. Fibermat Berhad has secured a 140 million ringgit subcontract from Hexatran Sdn Berhad to construct the Limpamaku Penang Access Road in Sarawak's Limbang division. Legenda Properties Berhad and Epicon Berhad have proposed a 543.2 million ringgit transaction under which Epicon will acquire a 60% stake in Legenda's construction subsidiaries Ramtau Urusan Sdn Berhad and LPB Construction Sdn Berhad. PA Resources Berhad has renewed its supply agreement worth 1.31 billion ringgit with First Solar Malaysia Sdn Berhad and First Solar Vietnam Manufacturing Co. Limited for the supply of aluminium extrusion profiles used in photovoltaic modules. Moving on, Paragon Globe Berhad has proposed to acquire an additional 195.6 acres of freehold industrial land in Sedenak, Johor for 127.3 million ringgit cash. Sin Kung Logistics Berhad has entered into a memorandum of understanding with Airport Authority Hong Kong to cooperate on regional air cargo opportunities and strengthen cross-border logistics connectivity. And that's a wrap for Midday Roundup with me, Madhavi on KleverStock. Thank you for choosing us investors. Stay tuned for our upcoming live stream programs.